Hi everyone, my name is Sam DeCourt, Wealth Advisor at Pi Funds, and welcome to our March video update. Joining us today, Pi Funds Chief Investment Officer Mike Taylor and Wealth Advisor and War History Expert Simon Hepple.
Hi Sam.
Mike, it's been a month since we've last had one of these videos. A lot can change, right?
Yeah, that's right. And the situation at the moment is we take it day by day. We try not to be glued to headlines because they swing from one day to the next and they often contradict each other. We look more to what's actually happening with the data. And in this case, it is really focused on the price of oil.
Mike, you mentioned oil. Everyone knows the importance of oil. Can you elaborate a little bit more? And also maybe you can touch on that milk price analogy that you shared in the office earlier in the week.
Yeah, so the world has endured energy crises in the past. We had one in 2022 with gas prices. I'm talking LNG, mainly throughout Europe, but also a spike in the oil price. And before that, we've had the first Gulf War and the second Gulf War. And for our older clients, they will remember the 1970s with the various crises around energy that occurred during that decade. So surges in oil prices, no stranger to the world. We are less dependent on oil as a global economy than we were 50 years ago. So that's helped somewhat kind of cushion the blow of rising oil prices this time around. And also, oil hasn't actually risen by as much as it did in previous conflicts. So the average gain during an energy crisis in the past has been about 170%. As at today, oil has risen by about 68, maybe 70%, assuming it's still trading at around $100 at the time of this recording. So there's significantly less gains than in the past. So your question about milk and how does that relate to oil? I guess, well, if you think about the situation, say, with New Zealand farmers, is that, why don't we sell our milk to New Zealand consumers for a cheaper price? Is that, imagine you're a farmer, you're trying to maximize your gain, maximize your profit. Unless you're subsidized by your government, you will sell your product at the international price, well, essentially to the highest buyer. And so, therefore, that's why we pay in New Zealand the same price for milk as it is on the international market. Now, if we compare that to the US, for example, so why are they experiencing increase in price at the pump over there is simply the same reason as that US oil producers want to maximize their gains, so they are selling their oil at the current spot rate. They're not trying to sell it at a discounted price to their consumers. Some countries around the world do subsidize oil, and the Gulf states are known for that. Of course, they dig it out of the ground at probably $2 a barrel, and therefore they can sell it quite cheaply to their local citizens.
And Mike, correct me if I'm wrong, but there's a bit of a common misconception that the US is self-sufficient with oil, and whilst they do technically drill enough crude oil for their consumption, they do actually import quite a lot from overseas.
My understanding is that the US is a net exporter of oil at the moment. They also are a net exporter of LNG as well, and some of which is going to Europe. So the US now produces around 15 million barrels a day, which is roughly in line with their consumption. And this is up considerably on what it was, say, 15 years ago when they were down to maybe 6 million barrels a day. So the US is in quite a strong position going into this. Yes, having said that, though, as I mentioned, they are still vulnerable to spikes in prices at the pump, which will not be good for the midterm elections for the Republicans.
Simon, back to you. Mike touched on previous conflicts, one of them being the Gulf War. Have you got some data to share on how things played out there in terms of linking this back to share markets, how the share market was impacted, how it recovered in the years following?
Yep. So if we just, by the way, I'm just an amateur historian. This is not my day job or anything like that, Sam. You have to appreciate that a lot of this just done for this video. But two recent wars in the Middle East, which come to mind in the last 30 years, are both ironically against Iraq, not Iran. In 1990, when Iraq invaded Kuwait, oil prices jumped about 30% in less than a week. And on the back of that, stock markets really tumbled. And pretty much for about 7 months, markets were not doing well on the whole during the entire conflict until Kuwait was liberated. But what's interesting to note is that within a year of that taking place, the S&P 500 was actually up 13%. 2 years later, it was up 27%. And 3 years later, it was up 38%. And the same thing kind of occurred in the second Gulf War in 2002, 2003, although admittedly we'd just gone through another downturn earlier than that, which had nothing to do with the Gulf War. But investors were really nervous about the same sort of themes, oil supply disruption, markets were crashing on the uncertainty. However, just like in the first Gulf War, they rallied very strongly, and then within, well, less than a year, markets were up over 35% from their lowest point. So you could, well, I think it would be wrong to say that wars are good for markets, but it just does show you that when you have short-term oil price fluctuations, it doesn't mean that longer-term markets are likely to be very dire.
Mike, you share with the team quite regularly your views on potential ways this plays out and different scenarios and probabilities. Can you share maybe a little bit about what are the most likely scenarios of how this plays out from here?
The most likely scenario is a de-escalation from both sides, in which case the US and Israel discontinue their bombing campaign. Trump declares victory. But there's probably some concessions that need to be made to Iran under that circumstance. I'm not sure quite what those might be, but one of them, I suppose, is definitely going to be that shipping is not disrupted through the Strait of Hormuz. The other one is, of course, that the conflict continues for a couple of months, in which case the oil price would probably remain where it is or go higher. And that would probably be the scenario which is detrimental to markets, and that markets would see a higher oil price as denting consumer confidence, leading to inflation and higher interest rates, etc., and a situation where markets would sell off. Notwithstanding that, is that when the conflict was eventually resolved, I still believe it would follow the playbook that Simon has mentioned earlier. It just might be delayed and from a slightly lower level. I guess the third and final possible scenario is that the regime may fall, and some of the objectives of Israel and the US may end up being met. Some kind of best case scenario. I probably ascribe quite a low probability to that. I think Iran has demonstrated so far that they've got the ability to wage a reasonably long campaign. So we're probably focusing on the base case of the first option that I mentioned.
Mike, in the past, when we have big periods of volatility and shocks, you share a lot about what the indicators are that you're tracking. What are the key ones you're tracking at the moment and why?
Sure. So we look at things like the volatility index, which is called the VIX. It measures how much volatility is in markets. So we look for that. We often look for a peak in volatility as an opportunity to re-enter markets aggressively. So the VIX can trade anywhere from about 10 up to, gosh, I've seen it go to like 100. At the moment, it's about 25. And so typically in spikes, the VIX, maybe close towards 50, is usually a period where markets capitulate, is what we say, throw in the towel and things like risk. Often that represents a buying opportunity. We also look at market sentiment. So at the moment, sentiment is relatively bearish, despite the fact that markets have, not sold off too much. We'll also look at what different factors are driving the market in terms of returns. Are investors moving towards safe havens like utilities and staples and out of growth companies? And of course, we will look at the underlying company earnings to see whether analysts are downgrading earnings. At the moment, we've not seen any adjustments negatively towards company earnings as a result of the war, but we are keeping a close eye on that.
Thank you, Mike. Simon, we'll end with you. If we jump a little bit back to what Mike was talking about, what is your view on how this plays out?
Yeah, well, without rehashing what Mike's just said, I mean, one of the things that I've observed, just being, reading a lot of books about history, is that we've always under this assumption that war will, favors the attacker. But you could probably say over the last 50 to 100 years, actually the opposite holds true, where often the attacker is the one that's at the disadvantage. And I don't see how this, may play out any differently. If we think about the Iran-Iraq war, ended in a stalemate after 8 years, Vietnam, Arab-Israeli conflicts. Yeah, basically, I don't know quite how this is all going to play out, but I think this will be a first for history if a war's been won just by aerial attacks. That hasn't happened in the past. More than likely, I'm guessing that this is what's going to end up happening, is that we're going to have a messy ceasefire of some sort. It's just going to be too expensive for everyone to have a long, protracted war, particularly when 20% of the world's oil supply is not flowing out of the Straits of Hormuz. And more than likely, it's going to happen in a back channel. It's not going to be happening through the eyes of the media. It may be a little bit of a standoff like what we had, years ago with Cuba. And I'd also add one other element to this as well, is that Iran currently exports, or did export, 90% of its oil to China. China is maybe even more important to Iran than, say, Russia. They'll undoubtedly play a role in ending this war in some way. We know for a fact that Iran has over 10 to 12% of world oil supplies, so it's going to remain an important player on the stage for a long, long time. But we'll just sort of see how things play out. But I think it's more than likely going to end in a ceasefire.
Thank you, Simon. And actually, my final words, messages to clients at a time like this.
Stay the course, I guess, is the message at this time, really. I see time and time again over the last 20 years at Pi is people put money in the top and they take it out the bottom. I mean, look, that's an exception. Not all clients do that, certainly. But, you want to try and do the inverse to that to help you improve your returns.
All right. Thank you, Mike. Thank you, Simon. And thank you, everyone, for tuning in. And we'll see you next month.